Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Absolutely. It is, it's great to be back.
Today, we're breaking down one of the most interesting, maybe perplexing setups in the real estate sector. We are looking at the massive hotel REIT, Park Hotels and Resorts, ticker symbol PK.
Right. The guy's holding a ton of upper upscale and luxury assets.
Exactly. On the surface, it's a fascinating contrarian play. You've got premium real estate assets trading at $11.42, flashing this massive 8.7% dividend yield.
Which is huge.
Right. But the real question for us as long-term investors is this. Is this a genuine bargain below replacement cost, or is it a classic value trap spiraling into a reflexive death loop? Are there hidden cracks in the fortress that the market is ignoring? That's what we're here to find out.
That's a huge topic. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number 1, the business engine and the moat.
Yeah, let's strip this down to the studs.
Let's do it. Break down the actual machine for us.
Yeah.
How does PK actually make its money?
So we have to look into the black box of the business model. At its core, they operate as a hotel REIT. They own the dirt, the physical buildings for these luxury assets.
San Francisco Hiltons, Hawaii resorts, that kind of thing.
Exactly. And their economic engine relies on two main inputs. You got RevPAR, which is revenue per available room, and F&B, the food and beverage side.
The massive corporate banquets and weddings.
Right. And I think we really need to distinguish this from other sectors we usually analyze.
Oh, for sure. Because unlike, say, a software company, this is not a recurring revenue model.
Not at all. And that's the key distinction investors just gloss over when they see that high yield. Unlike SaaS, where a customer signs a 5-year contract and pays every month.
A hotel is a daily hustle.
It is a daily hustle. Every single morning, your inventory resets to zero. Those empty rooms perished the night before.
You can't sell yesterday's empty room.
Exactly. You have to resell every single unit every single day. It's highly cyclical. You are literally fighting for occupancy daily.
Which just puts a massive amount of pressure on the sales cycle. You don't get to sleep well at night knowing next month's revenue is locked in.
No, you don't. And just to ground us in the current reality here, let's look at the size of this entity.
Right. The current share price is $11.42.
Which gives them a market cap of roughly $2.28 billion. So we are talking about a mid-cap company that controls a sprawling footprint of prime real estate.
Millions of square feet. So applying Hamilton-Helmer's 7 powers framework, which we love to use to assess durability, where does PK actually stand?
Well, this is where the debate gets heated. The bull argument, the whole reason people buy this stock is what Helmer calls a cornered resource.
Because they own irreplaceable physical real estate. High-barrier urban markets, resorts in Hawaii.
Right, location, location, location.
Yeah.
If you own the Hilton Hawaiian Village on Waikiki Beach, you possess a resource that is legally and physically impossible to replicate.
You can't just dredge up some sand and build another 22-acre resort there.
Exactly. The land is gone. The zoning is locked. So in theory, that's your moat.
It sounds like a textbook cornered resource. If I want to be on that beach, they win. So why are you skeptical of that?
Because they win the battle for that specific patch of dirt, sure. But do they win the customer?
Ah, the anti-moat argument.
Exactly. We have to look at substitutability. The barrier here is purely physical property rights. But capitalism dictates that if there are returns to be made, competitors will enter.
Even if they can't build a hotel next door.
Right, they arbitrage it. Think about the rise of high-end short-term rentals, Airbnb Luxe, or these new luxury condo developments.
Which aren't technically hotels.
But they serve the exact same customer. They are actively arbitraging PK's geographic premiums. Just because PK owns the hotel doesn't mean a condo block down the street can't rent out penthouses to those same corporate travelers.
So the cornered resource is just the building, but the service, the luxury stay, is definitely not cornered.
Precisely. The moat is narrowing, not widening. If a wealthy family can rent a penthouse with a private chef for the price of a suite at the Hilton, PK's pricing power evaporates.
And pricing power is really the ultimate litmus test for a moat.
Definitionally, yes. It's your ability to raise prices above inflation without volume degradation. Can I charge you more without you leaving?
And PK fails this test.
Miserably. Look at the Q4 2025 numbers. Group revenues grew 13% year over year.
Which sounds great. Top line is moving up.
It sounds fantastic until you see the smoking gun. Operating margins compressed to 9.7%,
Wait, revenue went up double digits, but margins crashed.
down from a historical 15%.
That shouldn't happen if you have a moat.
It tells you everything you need to know. They cannot pass the costs of labor, energy, and linens onto the consumer fast enough. The costs are eating the growth.
So they're essentially price takers on their inputs, but they can't force the customer to absorb it.
Exactly. Let's pivot to pillar number 2, financial resilience and the quality of earnings.
Yeah, because we just touched on labor costs. Hospitality is fundamentally a people business. What about soft power? Is there a culture or process advantage here?
We looked hard for it, and the answer is a resounding no. High churn is just structurally embedded in hospitality.
It's not exactly a career destination for frontline staff.
Right. Wage pressure is immense. And there's zero evidence of process power. There's no tacit knowledge making their housekeeping twice as fast as Marriott's.
They pull from the exact same labor pool, and for the guest, switching costs are basically zero.
Minimal. If I find a Hyatt down the street for $20 less, I switch.
So no soft power, no switching costs. That brings us to the actual cash. You have a metric you call the red flag metric for capital-intensive businesses.
Yes. Earnings are an opinion, cash is a fact. We must look at the discrepancy between EBITDA and free cash flow.
Because EBITDA earnings before interest, taxes, depreciation, and amortization is what Wall Street loves to slap on the headlines.
They love it because it hides the ugly truth of capital intensity. Look at Q3 2025. PK generated $137 million in EBITDA.
Which looks robust enough to cover interest payments.
But when you look at free cash flow, the actual cash you can use to pay down debt or distribute to owners was only $31 million.
Wow. Over $100 million just vanished between those two metrics.
It went straight into the building. People forget that upper upscale hotels are rotting from the moment they're built.
Rotting is a visceral way to put it, but the physical deterioration is relentless.
Think about an oceanfront resort. Salt air eats the HVAC. Thousands of guests drag suitcases against the walls, grind the carpets, ride the elevators 24/7.
That wear and tear demands hard cash.
If they don't replace the carpet or fix the AC, they lose their stars. RevPAR drops. This maintenance CapEx is mandatory. It's the cost of doing business.
So what's the actual conversion ratio there?
In Q3, it was about 22.6%,
And our rule of thumb is anything under 50% is a massive red flag.
deep in the danger zone. It means they're running on a treadmill. The luxury status requires constant cash injections, completely impairing true owner earnings.
So you think you're buying a cash cow.
But you're actually buying a cash-eating elephant.
That perfectly transitions us to pillar 3, the balance sheet, reflexivity, and capital allocation. Because if you have a cash-eating elephant, the absolute last thing you want is a mountain of debt.
And the debt elephant in this room is massive. $3.9 billion in long-term debt.
Against only $278 million in cash.
And contextualize that $3.9 billion against the market cap we mentioned earlier.
$2.28 billion.
The leverage is staggering.
And in a higher for longer interest rate environment, that is terrifying. Which brings us to reflexivity, the Soros model.
Right. We usually think fundamentals drive the stock price. But reflexivity says the stock price can actually influence the fundamentals.
Because when you are this levered, a depressed stock price becomes a weapon against you.
Exactly. PK needs to lower that debt. Normally, you'd issue new shares to a secondary offering to pay it off.
But at $11.42 a share, they can't.
It would be massively dilutive. You'd destroy shareholder value. You'd have to double the share count to even make it dent.
So they are trapped, locked out of the equity markets.
Which makes the debt look riskier to lenders, which raises their cost of borrowing. It's a negative loop.
And if the stock drops further,
They might be forced to sell their crown jewel assets just to cover debt obligations. Selling in distress collapses book value, driving the stock down even more.
it's a self-fulfilling prophecy. So given that fragility, how do we grade their capital allocation?
I give them a failing grade. Return on equity is a dismal 1.8%. Return on invested capital is well below their cost of capital, which sits around 8 to 10%.
So they are destroying value with every dollar they invest. It fails our 15% threshold completely.
But the part that really angers me is the dividend.
The 8.7% yield.
Paying out that high of a yield while sitting on a leverage bomb and generating minimal free cash flow is a mirage.
It's basically a bribe to keep retail investors holding the stock.
It's a suboptimal allocation of capital. They should be cutting that dividend to zero and paying down debt to survive. Instead, they're handing out cash they essentially had to borrow.
Prioritizing short-term stock support over long-term survival. Let's move to Pillar 4, valuation, risks, and the premortem. Is there any growth engine that can save them here?
I really wish there was. But revenue is stagnant to declining. It was down 9.2% quarter over quarter in Q3 2025.
Almost a 10% sequential drop.
Their only engine is entirely macro-dependent. They're just praying for a sustained recovery in large-scale corporate groups.
And mature capital-intensive businesses like this basically cap out at GDP growth anyway. You can't exponentially scale a physical building.
You run out of rooms.
So let's look at valuation triangulation. Is it cheap enough to be a cigar butt play?
It's trading at 11.9 times EV to EBITDA, which might seem okay for a REIT historically, but it's a premium to economic reality.
Walk us through the three methods.
Method A is mean reversion. Normalized PE of 10 on their 34 cents of EPS gets you to about $3.40 a share.
That is a massive drawdown from $11.42.
Method B is FFO multiples. 8 times their roughly $1.50 in funds from operations gets you $12.
Which is close to the current price. That's the bull case.
But FFO ignores the heavy maintenance capex we just talked about.
Right. So method C is the truth teller.
Owner earnings. Take the $120 million in annualized free cash flow, apply a generous 12 times multiple since there's no growth, and you get roughly $7.20 per share.
So your fair value buy zone is really in that $7 to $8.50 range?
Exactly. At $11.42, there is zero margin of safety. You are paying full price for a distressed asset.
Which perfectly sets up the premortem. Let's invert the problem. It's 5 years later, and PK went to zero. Why?
The kill list. Risk 1. The leverage and liquidity trap. Cost of debt spikes, or EBITDA drops just enough to trigger a covenant breach.
And when you breach a bank covenant, they can demand immediate repayment. Equity gets wiped out instantly.
It's financial death. Risk 2 is operational death. Structural demand destruction.
Remote and hybrid work permanently lowering the ceiling for corporate travel.
If Zoom permanently replaces even 20% of corporate conventions, RevPayer compresses permanently. With their high fixed costs, the model just breaks.
All right, let's bring it home with the final synthesis. I'm going to play the red team bowl one last time.
Let's hear it.
I'm looking at this and saying it trades below replacement cost, group revenues are up 13%, and I'm getting paid almost 9% a year to wait. Why am I wrong?
You're wrong because you are ignoring the catastrophic downside. The free cash flow conversion is in the danger zone under 50%. The capital structure is a fragile $3.9 billion of debt, and they structurally cannot raise prices faster than their costs.
So the final verdict?
Quality score is low, it fails all ROIC thresholds, valuation is fair to expensive.
And the dividend?
It's a total trap. In a mild recession, a 10% occupancy drop wipes out that thin 9.7% margin completely. The dividend gets cut, income investors flee, and the stock collapses.
So looking out 5 to 10 years.
It's an inferior compounding vehicle. No Lollapalooza effect, no scaling advantages. Best case, it's taken private by PE at a modest premium. But it will never generate geometric compounding for you.
Dead money walking.
I'll leave you with this final thought to mull over. If you are buying this stock purely for the dividend, are you actually just catching a falling knife in a luxury hotel lobby?
Ouch. That is quite the image to end on.
It's the reality of the numbers. Thanks for joining us for this deep dive. We'll see you in the next one.
Take care, everyone.